Welcome to the Glass is Half Full talk show. Let's face it, life can be tough in many ways. Here on the Glass is Half Full, we focus on how life is tough financially. Dealing with these financial realities can be a challenge. Essentially, we have to find ways to do more with less. Less money, that is. The show is focused on helping you discover ways to achieve that goal, even if you don't have a lot of money to work with. We'll be meeting people from many different walks of life. They'll share their stories and expertise. Looking to do more with less and maintain a positive attitude while you're doing it? Welcome to the Glass is Half Full. Now let's join Richard and his guests in the studio.
Now today we have with us David Grossman. He's a mortgage agent with, let me see if I get this right, Dave, Loan Central RMA.
That's correct.
And it serves the greater Toronto area. Dave has been arranging mortgages for people for over 15 years now, and he brings to us a wealth of experience and know-how to a business that, I don't know about the rest of you, but I find it somewhat mysterious and maybe just a little bit intimidating. So Dave, welcome.
Thank you very much, Richard, for having me on the show.
Pleasure. Now, I'm going to start with a start-out question, Dave. Okay, for somebody who is just starting out, a first-time home buyer and all that, what do they need to know?
Well, there's essentially a few things that lenders are looking for. Presumably, people would need a mortgage. Most people don't pay cash, so they need to have a savings of at least 5% down.
5% of?
Well, it's 5% on the first $500,000 of the purchase.
So and they need $25,000.
They need at least $25,000.
If the house is worth.
Right, and if the house is worth more than $500,000, they need 10% on the amount between $500,000 and $1 million.
Okay.
And if it's over $1 million, it falls into a different category altogether. They'll need at least 20% down.
So essentially, if they're buying $1 million house, they need $75,000 minimum.
Well, let's see. Yes, you're right. Good, quick math.
My specialty. So, is there anything else they need to know?
Well, besides having a down payment, the other things that lenders are looking for are credit, income, and the type of property. So credit is very important. People need to take steps to establish credit and maintain their credit. And
mortgage is credit, isn't it?
A mortgage is one form of credit, definitely. But for a first-time home buyer, lenders want to see that
a good record.
That they have a history, at least a couple of years, credit bureau. The assumption is people want to get mortgages from the bank or places like a bank, right? So for those types of borrowers, this is what we're talking about when we talk about 5 to 10% down. We're talking about bank mortgages. And they need to have income too. So if they're salaried, the lenders want to see job letter, pay stub. If they've been in the job for less than 1 year, they'll want to see some history of income. And also, as I mentioned, credit. People need to build up some credit.
That stands to reason, doesn't it?
Yeah.
So, if they're applying for a mortgage through your services, through you, okay, how do they go about that? What are the mechanics of doing it?
Well, the first thing people usually do is give me a call. I've got a direct number that people can reach me on, and I'd like to, usually have a quick conversation with people to start. Usually within 5 to 10 minutes, we can determine what's the scope of what's going on? Is it a purchase? Is it a refinance? What's the urgency? Is this a pre-approval, or does somebody need money to pay out a creditor, in 2 days?
Right.
So I like to start off on the phone.
So you know what you're working with, basically.
Yeah, exactly. And then once I know that there's a potential deal, then I will send people my application. It's a 2-pager. That they need to fill out and sign, and I'll give them a list of papers that we'll need as well in order to go after the mortgage.
And then the process kind of rolls from there, doesn't it?
Yes.
Okay. Now, you mentioned that the numbers we were talking about, this $75,000 on $1 million home, the down payment and all that. You said that's with a bank.
Yes.
Okay. Now, there are other places where you can get mortgages, right? Do they not have similar requirements?
Well, I mean, there's a number of what we call A lenders out there, banks, credit unions, trust companies, and with those lenders, you can get what they call high ratio financing. A lot of people have heard of CMHC.
Right.
So CMHC is it's a government-run organization, and they're there to help Canadians buy homes. So when it's an insured mortgage with CMHC or one of the other insurance, there are a few of them out there.
So CMHC is an insurance program.
That's right. It's an insurer, but it's not in the way that people normally think about insurance. You normally people think, oh, I'm getting life insurance for me or car insurance or whatever. This is insurance that protects the lender.
Right.
It comes at the borrower's expense, but it protects the lender.
And how does it help the borrower?
It helps the borrower because now they can get what they call high ratio financing or small down
So
payment.
they still want to buy that $1 million home. How would it help?
So now they can, well, now you can get it with just $75,000 down payment, because if it wasn't for the insurers, like if you don't have insurance on it, you've got to have 20% down if it's not insured.
Oh, see. So the bank mortgage will be through CMHC as well.
Yeah, banks.
So that's where the 75.
That's correct.
$1,000
That's an insured mortgage.
Okay.
Exactly.
And without that,
without insurance, if you have enough money, then you can do it uninsured.
But that would require
but you have
something
to
like
have at least 20%. That's correct. And at least 20% down.
what you were telling me about what people have to tell you and bring to you, and what you discuss with them in your 10-minute initial conversation with them over the telephone, perhaps. Is this different if you're dealing with somebody who's self-employed?
Well, there's a key difference for self-employed people often, in that self-employed people are going to minimize what they report for tax purposes. It's one of the benefits of being self-employed is that you can have legitimate tax expenses.
Let's stress the word legitimate.
Legitimate tax expenses, so oftentimes self-employed people, if they go to the bank, the first thing the bank says is, well, show me your tax returns and notice of assessments. And the net income per the tax return and the notice of assessments are often not really reflective of what's happening. You know, somebody could have $200,000 in sales and their net income is $40,000. The bank looks at the $40,000 and says, okay, we'll give you a $200,000 mortgage or a $250,000 mortgage, but this is somebody who might be able to afford $500,000 or $600,000 mortgage and want a bigger home. So we have lenders, not the prime banks, but we have alternative institutional lenders. They charge between a half a point to a point more than the banks. They'll also amortize the loan over a slightly longer period of time, so even though there's a higher rate, the payment is still affordable. And this way even self-employed people can get the mortgages that they want and still benefit from some of the tax write-offs.
Now, you mentioned A lender before, okay? And I've heard the term A, B, C lenders. How many are there anyways? Does it go
well, I would say A, B, C. some lenders can go to Z, but I would put them into, I think those are good categories, A, B, and C, yes.
Okay, those are the normal ones.
Those are the normal ones.
You would talk about, right? So, can you tell me, who are they? Like, what makes an A lender, a B lender, a C lender, and perhaps what are some of the pitfalls that might accrue to dealing with one or the other or the other? You know?
Right. Okay. So there are basically three different types of lenders, Richard, and we classify as A lenders, which are essentially prime lenders or bank type of lenders that most people would like to get a mortgage from. That's where you get the best rates. And the best terms too. Right?
Now, other than banks, who else is in that category?
Well, there are credit unions, trust companies, and there are many institutions out there that we consider to be A lenders that people have never heard of, that serve strictly the mortgage brokerage community.
Gotcha. Okay.
So, no shortage of A lenders out there, but they look for people who have very good credit and provable income. And the next category is a B lender. A B lender is also an institution who will take self-employed borrowers, so they're more flexible in how they look at income, and also more flexible on credit as well. So if people have credit issues, they might still be able to get a mortgage from a B lender. So the B lender will charge maybe a percentage point, sometimes more, sometimes less, premium over what the bank's charging.
The banks are charging 3.5. B
So
lender
the
might
B
go
lender
4.5.
could be 4 to 5,
4.25,
depending on
5.
the situation. Right. So that's a B lender, and you know, it's if you can get your loan from an institution, either an A or B lender, that's the best case scenario. If you're in a pinch, there are C lenders, which are also known as private lenders.
Okay.
Private lenders include individuals who just like to lend out money on mortgages, MICs, which stands for Mortgage Investment Corporations, that do private loans. And these are higher risk types of loans that you wouldn't be able to get from an institution, so you pay higher rates, you pay fees. So besides the fact that they're more expensive and should be avoided if possible, the other thing about the private loans or the C mortgages is that they're usually short-term loans. So lenders will want to know what's your exit strategy, or how are you going to repay the loan, and that's an important question.
Right.
As a borrower, if you need it as a bridge to get over a hump, okay, but you know, you got to think long term, right? What's going to happen at the end of the year? If this is a 1-year term and that lender is not prepared to renew the loan at the end of the year, because private lenders don't always want to renew, and if they do, the fees could be very high. So that's, you know, you need to have a plan to get out of that private mortgage, either by refinancing at the end of the year or selling the property.
So, for anybody, whether they're a first-time buyer or anything at all, the idea is to try and get an A lender mortgage, right?
Ideally, you want an A loan, but I also deal with a lot of people who don't mind dealing with B lenders. They don't mind paying a little bit higher because it allows them to save a lot of money on their taxes, as they're not shy about writing down the legitimate business expenses, and they can sometimes save you know, a lot of money on their taxes, and still get the mortgage loan they want, and they don't mind paying a little bit higher rate if it gets them into the property that they really want and can afford.
I heard, like a lot of people, I heard about this, something called a stress test.
Yes.
This is a relatively recent development, right?
Right.
Can you explain that to us?
Sure. So, well, at the beginning of 2018, the government decided that they needed to take some steps to cool down the market.
The provincial government?
This is the Canadian government, the federal government.
Okay.
So they implemented or imposed this stress test, which applies to almost all institutional lenders, except a few lenders that are provincially regulated. But the lion's share of institutional lenders out there are federally regulated, and what this means is that essentially they call it a stress test because you have to qualify for the mortgage as though it was 2 percentage points higher than the rate you're actually getting. So let's say you're borrowing at 3.5%,
right,
and they look at what the payment is and figure out how much you can afford and how much mortgage they're willing to give you. Well, with the stress test, the rate goes up from 3.5 to 5.5,
right,
and then they look at how much they think you can afford, and the result is that you can only get a smaller mortgage. So that has really thrown a wet blanket on the real estate market.
So if you're borderline in terms of your means,
Yes.
okay, it really might cramp your style on.
Yeah, it could
getting what you
definitely
want.
impact. But then there's some changes coming up again soon that are going to help first-time buyers. So I think they've acknowledged that they've done enough to cool off the market, and there's some new incentives coming out to help first-time buyers.
Well, I was going to ask you about that too. You hear there's a lot of public discussion about the government assisting people
Yes.
to be able to get into the market.
Right.
Okay.
Right.
What is there out there for people?
Well, I mean, there's a couple of things. First of all, there's been a program where you can use money that's in your RSPs. That's been around for quite a few years. I think the maximum was $25,000 per person that you could take out of your RSP tax-free. You did have to pay that money back over, I think, 15 years, yes, to put it back into your RSP, but you can take the money out tax-free. I believe the government has just increased that to $35,000 per person. And there's a new thing coming up very soon where they're going to actually contribute something, like be a partner in your home. So I think if you make less than $120,000 a year, the family, and your down payment is 10% or less, that the government, you could potentially get a part of that for the government, and they would eventually be repaid.
Repayable?
Yeah, but when you sell the house, and you have like 25 years to repay them. So I think it's a plus. I think it's a good. I mean, I've heard some.
Well, it's free money for 25
It's free
years.
money.
Yeah.
Absolutely.
No payments necessary on it, right?
There is a payment on it that's required.
Is it?
Yes, I don't want to say there's no payments.
Totally free.
They haven't released all the details yet, but we should know more very soon.
They have a similar program for RESPs,
Right.
where the government contributes to
Yes.
it.
That's right.
In our business, the insolvency business, we run into these things, as you know.
Yes.
And RESPs, it's not your field, I realize, but RESPs are a factor because they become an asset of the bankruptcy,
Right.
and but not the part that the government has put in.
Oh, okay.
So if there's $1,000 there, and I can't remember the percentage, but let's say for the sake of argument, the government put in 20%.
Right.
Okay, and then it's only worth $800 to your creditors if you're the owner of the RESP. Yeah.
Right.
So I wonder if it's going to be a similar kind of thing.
Well, yeah, it'd be interesting to see how that impacts people in the case of bankruptcy.
Yeah.
Yeah.
Because once they get into bankruptcy, insolvency in general, but bankruptcy. The big difference, of course, is that in the bankruptcy, the property itself is actually on the table. You know, the creditors through the trustee have a right to the equity of the property and all that.
Right.
Okay. Whereas, if you don't get to that stage, if you get into a proposal or something like that, then it's a hypothetical asset.
Right.
It's not really at risk.
Okay.
You know,
Understood.
Okay.
Yeah.
Okay, that doesn't take into consideration, that's not the actual money that the person would end up with if they sold their house, though. Essentially the costs of selling the thing, there's going to be a cost of some kind. So the real equity they might have in that place might only be $175,000 instead of $200,000 or something like that, right?
Yes.
Okay, and that applies across the board to everything, right? Equity is the difference between what a thing is worth against what you might owe on it.
Exactly.
Right? Okay, now there's always a further protection that goes into these things. It's called mortgage insurance. I know when you're dealing with a bank, they're very, very prompt to want to line up mortgage insurance.
Absolutely.
Now, this isn't insurance for you, is it?
Well, this is insurance for the borrower, life insurance and/or disability.
When I said you, I meant the book.
Yes, it's insurance. Well, I mean, if one person, the estate, if the mortgage is paid off, if a person dies, let's say, then the home goes to the estate free and clear.
Yeah, right. So it protects other people, but not the borrower.
Well, no, I mean, if let's say there's a husband and wife, it might protect one of the borrowers.
But the main person that it protects is the lender.
It protects the lender.
Because the money, if I'm married, if I buy a house in my name,
yes,
and call it $1 million house, and I have a $500,000 mortgage on the thing.
Yes.
And then I die, and with insurance, with the mortgage insurance, the insurance company will write a check to whom?
Well, if you get regular life insurance, you name the beneficiary. So normally you name the beneficiary as somebody in your family.
But that's regular life insurance, right?
That's correct.
Is that what they mean by mortgage insurance?
Well, the banks sell mortgage insurance, and I believe that if somebody dies, that the money goes straight to pay off the insurance. or if there's a claim, it goes to reduce the mortgage.
That's why they want the mortgage insurance, right?
That's that, and also because they like selling add-ons and extras, because you can make a lot of extra money selling different things.
But you cannot buy the insurance from the lending institution.
You don't have to buy insurance from anyone. Okay, it's a good idea to do so, because if you're thinking about if you have heirs, if you have family, a spouse, and you're thinking about the spouse, and if something should happen to you, would you want your heirs to have to sell, or would you want them to be able to continue to live in the property? If you want them to be able to continue to live in the property, you think, how are they going to manage financially, assuming you're the breadwinner or the primary breadwinner? So your estate, your heirs, will benefit by having insurance, and that's, I think, the main reason why people should get insurance.
Well, that speaks for insurance in general, right?
Yes.
It's always a good idea to have some protection against eventualities, right?
Right.
Yeah. We don't predict the future very well. As human beings, we're very, very poor at that.
Anything can happen in life.
But the whole idea of the concept, people hear about this business about mortgage insurance. Is it essentially an insurance where you're purchasing, in other words, it's costing you money, but you're insuring the lender from loss if something happens to you?
Well, yes. So, I mean, listen, if you died, if you die and you have a mortgage, it's not like the mortgage disappears, right? They'll still have a legitimate charge on the house. Because the question is how will they pay for it? If your income is gone, you may not be able to service the debts.
If you're gone, your income's usually going to be gone, right?
Right.
So that leaves the lender not getting paid.
That's correct. So whoever is managing the estate.
Is that why they insist on you having insurance?
Well, they don't insist.
They don't?
We have to offer people insurance, and they don't have to take it. We have to offer it to them, because I've known there were cases before where, let's say, somebody bought a house, and the minute you sign and your purchase is firm, like you've waived all financing conditions or anything else. Let's say that house is closing in 60 days.
Right.
If you die between now and the closing, you still have to proceed with that contract. Like your estate takes it, right?
Yeah.
So there was a case, from what I understand, where it was a husband and wife, and the husband died, and then the wife they didn't have insurance, and the wife was sued. Because she didn't close on the house, but she couldn't close, but she was sued. So that's why the minute you firm up your deal and you're dealing with your bank or your mortgage broker, you don't necessarily need to take the insurance from them, but it's a good time to be looking at insurance for your own benefit and for the benefit of your own heirs.
In the example that you just gave, the purchaser dies before the closing. The spouse, the beneficiary of the estate, was then responsible, or the estate, because it's hers, she's it basically. That estate is responsible for closing the sale.
That's right.
But the lender wasn't committed?
Well, the lender the lender can back out. See, because when we get people a mortgage approval, usually it's a conditional approval. And, like we'll submit an application and we'll say this person makes a certain amount of income. But the lender can get out of that deal up until like the day of closing. So a lot of times lenders are verifying
so they'll back out because now the
employment.
person doesn't have any income, he's dead.
Yeah, to verify the employment or something. They find out.
And yet she can't back out of the sale.
That's right.
So it's kind of a one-way street, right?
It's a one-way street. Yeah. Well, death is never a good. Usually not a good option.
No, you're right. Death is usually a one-way street too.
Yeah.
Okay. What a morbid subject to be talking about.
Any good news? This glass is half full here.
Let's stick on that particular philosophical plane. Okay, we'll keep it as half full. Okay, nobody dies. Okay,
Perfect.
I wanted to ask you though that even though nobody dies, unexpected things happen to people. negative things, sickness and so on and
Yes.
so forth, right? And these are the people we see, right? In the insolvency business, these are the people we see. But when somebody has some negative or unforeseen thing happen to them, can you, as a mortgage broker, help them through the use of their equity, whatever equity they may have in the thing, to help them get over rough patches, as we would call them, even though that might affect their credit rating?
Yeah, for sure. I mean, if there's equity in a home and people run into, some kind of problem, and things do happen in life, they can access the equity in the home.
Even if their credit rating has been adversely affected by what's going on? Because people don't give up right away when they start having problems, right? They try to keep things afloat.
Right.
But they can easily find themselves falling behind in payments and all that as they struggle to, maybe take from Peter to pay Paul, and things like that, right? And so 6 months down the line, the problem hasn't gone away. They still have equity in the home, but now their credit rating has become besmirched, so to say. Okay?
Yes.
So you can still help them?
Yeah, well, so a lot of lenders want to see that there's a plan, right? So they're not, they wouldn't normally, let's say, just lend money and not consider the borrower's credit and what's going on, but they might look at it and say, well, look, you have $50,000, let's say, in credit card debt that you're having trouble paying. If we get you a mortgage, we can maybe reduce those payments. Some credit cards are 20-30%,
for sure, yeah.
right? So a mortgage, I mean, in this case, if the person's without a job, let's say, they're not going to be getting money from A or B lender, but even if they're borrowing money 10 or 12%, it might help them to solve the problem, and then they can improve their credit. Hopefully they're going to be re-employed again soon.
It'll certainly be better than the 19 or 26% they're paying on their credit cards.
Exactly.
Yeah.
Exactly.
And they should be looking into that. See, this is one of the
Yes.
options we discuss with people when they come to see us. When people come to see us, we don't just talk about bankruptcies and proposals. We talk about consolidation loans. We talk about using resources that they have or might have available, might be accessible to them to try to avoid having to do the bankruptcy or proposal.
Yes. I think that people should start looking to have conversations with professionals like yourself and me before they start missing payments. Because as soon as they start missing payments, like we get people who come to us, they have all kinds of equity in their house. And we may have been able to get them, but if they miss payments and they let their credit go downhill, then when they come to us, we can still get them the loan, but it's going to, if the equity's there, but it's going to cost more money. It's just going to be more expensive if they've let their, so they should talk to people, professionals, before they start missing a lot of payments for some guidance.
Well, it's a message in our advertising. We try to get that across all the time.
Right.
Why wait till things have already gone downhill before getting advice?
Right.
And advice is easy to give, not so easy to take, I understand. But,
Apparently.
we have a number of people, this happens fairly frequently, they're insolvent, and that means that they can no longer keep all their creditors happy through their own resources. And so they do something with us, but most people don't want to do a bankruptcy. In fact, I think in the 30-some-odd years that I've been in this business, I've never met anybody who wanted to do a bankruptcy.
Right.
I've met an awful lot of people that did because they had to, but they sure didn't want to. However, what we do, we provide an alternative to that. It's called a proposal or a consumer proposal, depending. Right. And they do a proposal, but they've got some equity in the home and so forth. So they're paying this proposal, and usually proposals are done over a 5-year period, a 60-month period. And they get maybe 2 years into it or 3 years into it or something. Okay? And it's like anything else, it's a negative drag on them.
Right.
Okay. It may have a positive end, but it's a payment that they have to make, right, and so forth. So we suggest to them, we very often suggest to them that they look at using the equity in their home to maybe pay off the proposal.
Right.
So even though they've done something under the Bankruptcy and Insolvency Act, okay, can you still help them with that?
Well, for sure, yeah. We do get people who are in a proposal alone, but the lenders will typically want to see the balance of the proposal being paid out in one shot from the loan proceeds. I think
That's a normal consolidation loan factor, isn't it? They don't want payouts.
No,
They
because
want 100% payouts.
they want 100% payout because I think, correct me if I'm wrong, but let's say there's a $1,000 a month monthly payment on a proposal. If somebody was to make a lump sum payment, it's not going to reduce to $1,000 a month. No, it's not. So
Well,
the only way,
shouldn't say that. It prepays the proposal.
right?
So they can reduce their payments if
Okay.
they're ahead, right?
Okay, all right, that's an interesting point. Well, generally speaking, though, the lenders, they want to see the proposal paid out in full from the proceeds.
Yeah.
Now, but I think it's worth mentioning, though, that sometimes when people are looking to do a proposal, they can get a mortgage at the same time and do a lump sum
In other words, they
payment.
can use the equity
Right.
to use the proposal process, to fund the proposal process,
Right.
to get out of debt.
Right, and then and rather than having payments over 5 years, they could do it in a one-time shot, and
Yeah.
it's done.
And then amortize their payments over a longer stretch and
Right.
through the mortgage process and all
Right.
that. Some of our viewers, hopefully not many, but some of our viewers might be people who have done a bankruptcy or a proposal. They've perhaps gone all the way through it, perhaps they're coming to the end of the process or something like that. And one of the things that's going to be uppermost in their minds is the regaining the good credit status that they used to have.
Yes.
Okay? Can you help them with that?
Yeah, well, there are some things that people should do, can do, to reestablish the credit. The first thing they can do is they can go and get a secured credit card. Home Trust is a company that offers it, and basically a secure credit card is you put down some money which they'll hold on to. So, you know, you can put down $1,000 or $1,500. They'll hold the money, but they'll give you a credit card that you can start using. So it's convenient, and it's a way to start rebuilding your credit.
Does it operate just like a regular credit card?
It operates like a regular credit card, except they're holding on to some of your money.
Secure, yeah.
Which, you know, and that's a good way to start. You can also go and get a car loan, because the car lending companies are, you know, pretty flexible. They'll charge you a higher rate on a car, but it's a good way to start to reestablish credit.
Right.
So you can you can start reestablishing your credit, and you can get a mortgage from a bank if you've had 2 full years of reestablished credit. So it's by no means game over if you declare bankruptcy or go for a proposal. You get a second chance.
Is there a difference in your experience, if people have done a bankruptcy or a proposal, a difference in the speed with which they can recover their credit rating?
I haven't really noticed a difference. As from a lender's point of view, they look at the date of completion of a proposal. They
Right.
want to see like a Schedule A bank or an A lender. They want to see 2 years minimum reestablished credit, at least from my experience, that's what I've seen. Whether it's a proposal or a bankruptcy, 2 years from the date of discharge of the bankruptcy or successful completion of and it's very important that you make all of your payments on time in the proposal.
Right.
Right? We have lenders that will give you a mortgage loan, the B lenders, you know, the alternative institutional lenders
Right.
that we talked about earlier. They'll give you a mortgage the next day after a discharge of a bankruptcy or completion of a proposal. You'll need to have it, you know, probably a minimum of 25% down. You need to have good provable income, but they'll do it even 1 day after the discharge. The one thing is, though, is that you may not ever be able to get a mortgage from an institution who was part of the loss. So if they lost money,
Have you seen that? Yeah.
Yeah. So if you lost money with Bank of Montreal, you go to Royal Bank. If you lost money with both Royal Bank and Bank of Montreal, you go to TD. If you lost money from all of them, then you have a problem.
There's always credit unions.
There's lots of lenders out there. So you take steps to reestablish your credit. You do get a second chance.
But this can happen immediately.
It can happen immediately. Not with a bank, but with our alternative lender. They'll charge a little bit higher rate, but if you're back in the saddle, you're making money, you can show you're making money, and you've got 25% down.
But it doesn't happen by itself. You have to be what they call proactive about it. You have to be the one to make it happen. In other words, you can't sit on the sidelines and expect your credit rating to come back automatically.
That's correct. You got to get out there. Whatever the situation was that led to the loss, hopefully, if it's something that's in your control, hopefully you've learned something from it. Sometimes it's a business loss. You've learned some valuable lessons. It took you a little while to get yourself set in the right direction. But
people that go through a process to deal with an insolvent situation, they're not terribly happy about it, and generally speaking, by the time they get through with it, they're pretty well resolved not to repeat this process ever. Now,
right.
It happens because can't foresee the future, but they're very, very well aware that they really don't want to go through this again.
Well, it's a second chance. It's a glass half full, right? They've learned some lessons, and it's a renewal. I mean, to be basically let off the hook for getting into all that debt.
On that particular point, I was telling you earlier that when people come in to see us, if they have a home, the standard thing that comes out, it's the first thing they say to us is, "I don't want to lose my house." Now, what would you say to somebody like that at that point?
Well, if you decide to do a proposal or a bankruptcy, it doesn't mean you're going to lose your house. So you have to disclose in the case, I believe, because those are court ordered, right?
Yeah, you have to disclose.
So everything has to be disclosed. But I know that a good trustee like yourself, there's ways to arrange things so that people don't have to, don't necessarily lose their house.
You see, we say good trustee. Yes, the idea of the bankruptcy is proposal, the insolvency process, the law, is to serve both. But you have two protagonists, right? You have the debtor and the creditors, and they're both supposed to get something out of this law. The debtor will get a fresh start and all the rest of that good stuff, but the lender is going to have to. Usually, the lender will have to resign himself to get what he can from the assets, et cetera, et cetera. But very often, if there's equity in the home and all that, we're interested, and so are the creditors. Creditors agree with this completely. That as long as they get the kind of money out of the situation that they were going to get if the house were sold, they don't mind if the people get to keep the house.
Right.
All the same to them.
They're not looking to put people out on the street. Right?
That's right. Another way of saying it is they're people too, I suppose. Right?
Yes.
Yeah. All that. Well, David, I appreciate you coming down, and I'm going to ask you one last question.
Sure.
That is, because people looking at you here and listening to you, what would you say to them in terms of why they should come and see you under whatever circumstances they're in?
Well, whatever the circumstances, it's important to talk to people who know their business. I've been in mortgages for a long time, and I deal with both prime borrowers, and actually more of my business is in the alternate space, dealing with people who are not getting what they want for any reason. And I've had a fair bit of experience dealing with people who have credit issues and who have debt issues, and they're
I have to tell you, David, I could tell that.
Yeah. Okay.
So it's quite obvious you know what you're talking about.
So that's good. Thank you. I appreciate that. So don't be afraid to pick up the phone and give me a call, because you just never know. And
it's a no-lose situation, isn't it?
It's a no-lose situation. There's no charge for advice. right? And I don't charge for it's not legal advice.
Not even, right?
Right? We don't get paid unless we arrange a mortgage, but that's the nature of our business, is, you know, we want to help people, and they can pick up the phone and definitely tell them what we know.
I've had this sitting on the table. You know, I've written this book, and the program itself is called after the title of this book. Its intention, well, I suppose there are many different little intentions, but one of the main reasons why the book got produced was because there's a number of people I've seen go through the bankruptcy, the insolvency process, and let it get them down, let it diminish them in some way. And I feel very strongly that the process should really have a different outcome, a little, you know, ultimate result. And when people deal with us, is we try to get at that, make sure that they can see the process that we're going to apply, which is a problem-solving process. They can see that it gives them an opportunity to make life better.
Absolutely.
But you can't get there unless you have the right attitude.
That's right.
You know, and so we called it this, the glass half full, just to denote that attitude is a huge part of really accomplishing anything in life, right?
Absolutely.
So what you would say is that maybe these words have a lot of impact on your business too?
That's, you know, every day that's the way you have to choose. You make a choice how you see things that come your way, their problems or their opportunities. So yeah, I think it's a great approach, and I think you have a great show, and I appreciate you inviting me to be on it.
Well, I'm very glad. Pleasure to have you.
Thank
you. Glad you came and all that, and because you said such nice things about the book, David, you can help.
Well, thank you very much. Will you sign it for me?
I'll leave it signed, yes.
Okay, amazing.
Thanks a lot, David.
Thanks a lot, Richard.
You're welcome.